Welcome, and thank you for joining us for another Truck Writers webinar. Today we're going to be talking about why proper corporate structures matter with Nathan Nelson and Gary Carlson. Before we begin, we'd like to tell you a little bit about our sponsor. This series has been sponsored by Truck Writers, which since 1983 has become one of the largest and most knowledgeable truck insurance agencies in the nation, and will continue bringing you business topics of interest to trucking organizations. Quickly about your technology today, your lines have been muted for the duration of the webinar. You can enter a question anytime. Slide open and close the question box with your arrow, but don't click the black X because it'll end your session. With that, it's my pleasure to pass this over to our speakers.
Thank you very much, and thank you to Truck Writers and Sean Sullivan for inviting us to our second webinar series here. My name is Nate Nelson. I'm an attorney at Messerly Kramer, downtown Minneapolis. I buy, sell, merge, destroy, and create companies. I also draft employment contracts, owner-operator agreements, broker-carrier agreements, and I will help people with wills, trusts, powers of attorney, and living wills. Gary?
Yeah, thanks, Nate. I'm, again, happy to be part of this webinar team as well. I'm Gary Carlson. I'm a CPA partner with Lawrence Cumpston and Associates in St. Paul. I've been practicing for over 30 years in the transportation industry by providing tax, accounting, and consulting services.
Excellent. Before we discuss what corporate structure we suggest you consider, we wish to describe why entity selection is a key part of the structure. Every corporation starts off as a C corporation. We believe most of you listening in on the call have already elected S corporation status, which we would highly recommend. But if the holding company structure technique that we're going to propose today is followed incorrectly, one consequence could be the loss of S status. So Gary, this slide would probably demonstrate what happens if we lose S election, don't elect S election, become a C corp.
Yes, I can walk through this. The key issue is going to be the double taxation. So if you start at the top, obviously the corporation is earning a profit. What's going to happen then is that there's an initial arrow that's moving to the right, showing that the corporation is going to be obligated to pay income tax on that profit to the Internal Revenue Service. If you drop down to the bottom of the screen, we're going to see what it says on anything that's left over, and if we distribute that cash to the shareholders, they too have a line that's being driven up to the Internal Revenue Service. So we've got the major issue of double taxation, and in an industry that's arguably one of the most taxed in the form of payroll taxes, fuel taxes, highway use taxes, excise taxes, sales taxes, property taxes, etc. It's nice for us to have a plan to possibly make one of these go away.
Wonderful, and magically that could happen with the S corporation election.
Yeah, so here we now have the screen showing a similar flow of profit down to now what's considered the S corporation. We have a giant X through one line to the Internal Revenue Service, which means that we have eliminated one of the taxes that could occur under the other structure. A lot of tax planning techniques allow deferrals of tax. This one's elimination, so it's clearly very important that we follow proper form.
And for purpose of clarity, the S corporation has the exact same corporate shield, the same corporate protection as a C corporation would have. So Gary's talking about an efficient tax election. What are the C corporation tax rates? What are we talking about? What are we trying to avoid? Well, initially on the first $50,000 of income, the C corp is taxed at 15%, up to $75,000 at 25%. But for most of you in the audience, we're going to be looking at, you're going to be making income greater than $75,000, so you're going to be at a 34 or 35% corporate tax just paid by the corporation. Gary, what happens when that after-tax money gets pushed down to the shareholders?
Again, we have that second layer occurring, and that's going to be, the dividends will be taxed at capital gains rates, which depending on your personal taxable income levels, that'll be at an additional 15 to 20% on those additional dollars distributed out.
So, in a quick recap, advantages to an S corporation, as we discussed, they pay no federal income tax, they pay no state tax. You can work with somebody like Gary if you're the owner of an S corporation, and we can probably somehow reduce employment payroll taxes, so now we're getting more than even one tax reduced. And unlike LLCs, a close cousin to S corporations, the S corp can do tax-free stock swaps and issue incentive stock options. We'll discuss those a little bit later in this webinar. Disadvantages of the S corp: they can't take advantage of that 15 to 25% tax rates. As you see, those are all gone though after $75,000 of income. So a mature corporation, that's not going to be a substantial effect. Income is taxed to shareholders whether or not it is distributed. Only certain types of persons or entities can be shareholders. Only one class of stock may be issued by the corporation. However, we can have differences in voting, differences in control. So non-voting shares can exist. And all distributions to the shareholders must be pro rata. Gary, what does it mean that income is taxed to shareholders whether or not it is distributed?
That could probably be best described in an example. Assuming you made $1 million of profit and there's two shareholders, effectively a K-1 would be issued to each shareholder indicating there's $500,000 each of taxable income that has to be reported on the individual return. Obviously, when that's added to your wages, other forms of taxable income, there is tax due on the overall calculation of taxable income, including the corporate profit. The corporation should generally distribute enough money to cover that tax due.
Well, that's great. I have seen cases, though, where the corporation is either unable, it's not liquid enough to make distributions to the shareholders. Does that give them a get-out-of-jail-free card come April 15th?
It does not. Again, as you said, it's whether or not it's distributed is taxed.
So they're going to actually have to look under their couch covers or under the car seats to find some cash to pay the tax, because even though it's been attributable to the corporation, it hasn't been distributed. We've also seen, and don't encourage it, but we've also seen where majority shareholders have punished minority shareholders by not making distributions of tax exposure to the other shareholders, and that's that's a tactic that needs to be addressed when you're setting up the entity. Otherwise, you run the risk of being subject to maybe being allocated tax with no money to pay the tax. But anyways, some commentators have pointed out that the maximum individual tax rate, 39.6% for basically those persons 500,000 and above, is actually greater than the 34 or 35% that their corporations may be taxed at. So Gary, does that make it better to just be a C corp instead of an S corp?
No, I still don't believe so. As we showed in the previous slides on the impact on the double taxation, especially if you're talking both federal and state tax at the corporate level and the individual level, the C corp can still create tax rates of up to 60 to 65%, which still, in the majority of the cases, almost all cases, I think would be advantageous to become a C corp.
So to say it simply, paying one level of tax is better than paying two levels of taxes.
Agreed.
Our goal is to illustrate a parent holding company structure. And this is why proper corporate structure matters, and this may best be described by the following example of an ideal candidate. A mature corporation has several operating divisions and other appreciated assets owned by the corporation. Should a claim be made against one division, all of the assets of the corporation could be levied to satisfy the creditor. By creating separate subsidiaries to silo the divisions, then the holding company structure may actually isolate the activities of one division from another. We can't stress enough to maintain this structure. The separateness of each corporation must be demonstrated, and each corporation must act independently. So what it looks like is we have shareholders. You don't need just 3 shareholders. We have 3 illustrated. It could be a 1 to 100 shareholders, and we even know some exceptions if 100 is not enough. But between 1 and 100 shareholders would own an S corporation holding company. But Gary, what I don't like about this slide is we have the S corporation holding company owning actually C corporate subsidiaries. So as we just described, we have the earnings and profits at the C corp being taxed at, say, that 34 or 35% level, and then you described how when the money is distributed out of the subsidiary up to the parent, it's going to be taxed again at the dividend, at the capital gains rate for the shareholders. What happens to losses?
Yeah, you can have a potential situation here too where some of those losses could get trapped if you have a loss of one of the C Corps and income on the other. It may be difficult to offset those two. In addition, obviously, if you have a sale of an entity at a C Corp level, the tax consequences can be extremely adverse, an asset sale.
So here's our preferred structure in a simple illustration. We have 1 to 100 shareholders. Here we pick 3, owning an S corporation holding company that actually owns 3 separate, I'll call them silos, but each silo is a qualified subchapter S subsidiary. Gary, what magic can you work here?
Well, I really like this structure from a tax perspective. We have a situation where only one tax return is required to be prepared at the holding company level, and we clearly now have the ability to offset income or losses in each of the silos depending on the results of those entities. And we don't have to worry about added tax pressure of trying to shift income or losses in order to deal with a situation where you have one subsidiary profitable versus another one not making taxable income.
So just for a simple attorney who has to take his shoes and socks off to do math, you can basically net the losses of one against the earnings of another of the subsidiaries.
They will be all offset and allocated into 1K1 to the shareholders out of the holding company, correct?
I promise that'll be the last math I try to do. So there are technical requirements, however, to become a Q sub. That's a qualified subchapter S subsidiary. And if these requirements are not satisfied, not just the one silo, but the whole darn enterprise falls into a C corporation, the double level of tax, layer of tax that Gary has demonstrated is going to be in the 60 or higher percent tax bracket most likely. So the rules, to be a Q sub, the entity must be a domestic corporation. There must be only one class of stock. Again, you can have the voting and non-voting distinctions, but all the stock must be owned by the holding company. The holding company must own 100% of the subsidiary, and it must elect to be a Q sub by filing Form 966 with the IRS, and Gary's office could definitely help with that. Other requirements to become a Q sub, there's no limit on the actual number of subsidiaries the parent S corporation could own. The Q sub election is effective until it's either terminated or until the S corporation, the holding company's election, is either blown or removed. And the type of business, a S corporation holding company structure will not work for a bank, a financial institution, insurance company, or other ineligible businesses. The term ineligible business is actually a technical term. It generally doesn't apply to anyone that would be on this call that we would expect. So here, this next slide illustrates what we're going for. We got now 2 shareholders. You can see that they own different percentages of interest in the holding company. That holding company is the S corporation parent, and the holding company owns 100% of 3 silos, 3 separate subsidiaries described below. And it looks like there's a real estate subsidiary and then 2 operating companies. Gary, why is there a line, an X through the real estate?
Well, a lot of us can be, there's a general tax rule that you pretty much always want to keep a depreciable property such as real estate out of a corporate entity structure. It can be very, very expensive from a tax perspective to try to get that real estate out later. It'd be much more appropriate to separate that out into the separate LLC. You can still achieve separation of business activities as long as you have the formal leases at fair market value with the related service entities as applicable.
So just free advice, if you own real property, not you, not the corporation, but an LLC, a single member or a multi-member LLC, is oftentimes the recommendation of choice for real estate. And as the next slide now, we're going to show back to our preferred structure, 1 to 100 shareholders owning a parent company which owns each separate silo in its own qualified subchapter S subsidiary. Again, to underscore the point, no real estate should be owned by the holding company or any subsidiary underneath the holding company. So now we have our structure set up. We have the shareholders owning the holding company, which owns all the subsidiaries. We have an asset company, 2 operating companies. But it looks like, Gary, in this illustration, we have a claim occurring at the second operating company. in theory and in our desired result, the first operating company, no claim should be affected. The claim should not affect the asset company. The holding company didn't do anything wrong, nor did the shareholders. So our goal is to contain the liability or alleged liability just to, in this case, services 2. However, if a claim actually does occur, who's going to be targeted? We're going to see that the plaintiff's lawyers are likely going to start firing arrows and naming the whole enterprise in this lawsuit to try and satisfy the claim that occurred in silo number 3 or services 2 on the screen. I want to make real clear, just because you're targeted doesn't make you liable, and our goal is to contain the possible exposure to the silo where the alleged claim occurred. So despite all this, Gary, what happens when our clients call you because a claim occurred at silo 3, if you will?
Well, the initial reaction is generally one of frustration. The thought process is, wow, why did we spend all this money and take all this time and effort to break these things into separate entities, and they're going to be naming every single one of us in a lawsuit. The question is, well, why did I spend that money? Why didn't I leave it alone?
Sure, and you'll see in the next slide, if the claim occurred in 1, that's what we're trying to share. All the eggs in one basket can be used to satisfy the creditors. But Gary, I too have heard clients being frustrated when all of their businesses get named in a lawsuit. But to suggest they would be better off with just one corporation reminds me of the old joke about the customer who was asked how many slices he'd like his pizza cut in, 8 slices or 4. The customer replied, oh my, I could never eat 8 slices. Please cut it into 4 pieces. Well, if you finish your plate, you ate the whole pizza, whether it was 8 slices or 4. Here, if you have all your divisions within one company, then everything on your plate can be used to satisfy the creditor. Our goal, again, is to put only one slice or one silo at risk, even if it may look to the plaintiff like 8 pieces or 4 pieces of pizza are on the table. So this next slide actually shows a tweak to the structure. Say you have somebody who is extremely risk averse or has highly appreciated super precious assets that they just can't handle being even so closely exposed to the operating companies that they don't want to be underneath the parent company, the holding company, and they want to be out of the solution altogether. Under this scenario, you'll notice the difference. We have the 2 shareholders, 60 and 40 again. But not only do they own the holding company, they actually own the asset company. The holding company has complete ownership, as it's required to, of the 2 operating companies, Services 1 and Services 2. But the asset company is on the side. In a lawsuit, Gary, what's your take on that structure?
Well, I agree. It could allow some additional separation from a potential loss. But one of the issues, a couple of tax issues here that would occur is especially if we're talking a separate asset companies, it's equipment leasing company. Generally with depreciation rules now, you can throw off some pretty significant losses using all the accelerated depreciation options we have, and that is available to then immediately offset income in Services 1 and 2, as I spoke of before. In this case, that may not be the case. We could trap depreciation in the leasing entity, and again, I guess the other disadvantage would be we'd have 2 tax returns instead of 1.
So you can just see that this section, this structure suggests inefficiency. Legally, I guess in theory it should work, but in practicality we're right back to where we started. Oftentimes if a lawsuit were to occur, if there was a claim at Services 2, everybody's likely going to be named in the suit. Again, just because you were targeted does not make that division or that silo liable. The whole structure, whether it's owned underneath the holding company or if it's broken apart like we see here, it's going to really depend on how well did you maintain the separateness of each entity. Gary, maybe you can give just a couple of thoughts or tips on how to help evidence separateness of the entities.
Yeah, I think it goes back to that, one of the original slides, it's saying that each entity must follow corporate formalities and act independently in order to make this concept successful. Examples would be, I'd want to see separate bank accounts, I'd want to see separate lines of credit, credit facilities, formal promissory notes, if there's intercompany borrowing, and actually follow the terms, pay the interest, pay the required principal. You'd want formal lease agreements, again, using fair market value rents. I'd strongly suggest separate financial statements for all the entities. I'd look for management or service contracts when applicable for employees that are wearing multiple hats. You clearly want, in this case, I think it's equally as important to, in this case, to follow form as well as substance. Sometimes people will argue substance over form. It doesn't work. You need the required form.
Very well said. And I know that the second we leave, or sometimes shortly after our relationship with the transaction moves on, the clients get bored or lax with the details. But again, if you take two things away from this seminar: one, real estate doesn't belong in corporations, and two, follow the forms. An ounce of prevention is worth a pound of cure. And if you don't, I guess we'll all say thank you as we try and navigate through at great cost and uncertainty to help you get through the process. The next slide here is dealing with the treatment of multi-divisional personnel. Oftentimes, key employees perform services for many different silos. My quick take on, but they're only paid out of one corporation. They get one W-2. All their benefits, all their 401k are all under one silo, but they assist in maybe 2, 3, or more of the silos. My quick line on this is there's no free lunch. So if key employee is being paid by Services 1, there's absolutely no reason that he should or she should be performing services for Services 2. Okay, oftentimes our clients aren't big enough to complete or don't see it efficient or necessary to have complete different staffs for every separate silo. What's a way to best protect the structure and yet achieve the result that we're trying to have, where we can contain the liability to the act where the any alleged occurrence happened?
Yeah, I think you can maintain the efficiency of having one entity providing the payroll through common paymaster rules, but as there's additional lines now on the graphs, the illustration saying management contracts, there needs to be some formal contracts indicating that if you are wearing different hats and providing services to possibly more than one of the organizations, that's well documented, and it's under a contract clearly and explicitly indicating what types of services are going to be performed, and then they are going to be performed.
So if you're like many of our clients that have the separate silos, but multiple one employee or many employees performing services for multiple silos, talk to Gary or I, as we can help you structure that as best as possible. So now let's talk about money. How, Gary, should the money flow?
And looking at this structured, obviously there's many ways to get money from one entity to another. And
let's use this example. Let's say that that the operating division Services 1 is going gangbusters, but Services 2 is having a tough time, a little short of cash.
Correct.
It's our knee-jerk reaction for our clients to just shuffle the money from Services 1 to Services 2, or even more common, Services 1 will just pay the obligations or the bills of Services 2. Gary, I'm going to tell you as a lawyer, that's not going to hold up in court, but tell me how you would like to see it for accounting and to maintain the integrity of the organization structure.
Yeah, I totally agree that I think there's a common battle here for the desire for efficiency versus what I will show in a proper form. A lot of times people think it's easier just to transfer across from Services 1 to 2 versus where I'm going to recommend in this illustration that we literally do it in a two-step process where we go up from Services 1 to the holding company and then down to Services 2. The clear argument, and what a jury would understand, is that I have a parent company that has one of my entities that has excess cash that's available, and I'm going to say as parent, please give me some of that money because I need to give it to one of my other siblings or services in order to provide operating cash flow. So I'm suggesting strongly that the proper form is to go up to the holding company and back down. to the other entity.
And that's a tax-free movement of the money. The fact that that may be profit, the tax will be paid anyways at the end of the day. But for your shuffling, if you will, that's all tax-free.
That's all tax-free. It'd be all tax-free if it went across. The main difference is we don't have to really paper up. If it goes across, you better be make that intercompany loan real. There's going to have to be promissory notes, payments, reasons to pay it back, and it has to be paid. Otherwise, a plaintiff attorney will clearly argue, and nobody else, no other businesses would do this. They wouldn't just willy-nilly shuffle money back and forth and not require payment. So I think moving up and then back down would be the best solution.
So if it goes left to right, if you're looking at the slide, we want promissory notes, evidence of the obligation to repay, and then actually make the payments under the notes and make the notes commercially reasonable. If it goes up and down, like we're seeing the dollar signs on the slide, that's a distribution up to the holding company, and then it's a contribution down to the services company that needs the funds. Here's a risky structure where the separateness of each silo is not maintained. Here we have the key employee performing services for all the subsidiaries. We have money flowing around like crazy. So despite the fact that we have the holding company owning 100% of each of the subsidiaries, we'll assume all the S elections and the Q sub elections have been timely made. What we don't have here is the paper trail to support why the key employees performing services for multiple divisions, and why is the money flowing between one silo to another. And while Gary, these techniques and these structures and these charts may seem complicated and there might be a lot of rules to remember, there's one thing to really be certain of. Plaintiffs' lawyers will pound into the juries how this structure works, because juries understand money. And the juries will be able to see why the money is flowing or why the key employee is performing services without compensation or without money being exchanged between the silos. Sometimes we have corporate patriarchs, matriarchs, owners of the enterprise that want to really reward a non-shareholder key employee. They come to Gary, they come to me, and they'll say, let's get the key employee some stock. Gary, what happens here?
Well, what's going to happen is, obviously, if he becomes a shareholder, he needs to become a shareholder of the holding company, because that's the company that owns all the underlying subsidiaries.
The S election would be blown if he was to become a shareholder of silo number 3.
Correct. Yep.
That has to be 100% owned by the holding company.
And they're going to become a part of the entire entity, rather than possibly your motivation may say you want to make them just part of one of the other entities.
If he's going to have shares, the only place that the key employee can have shares is going to be at the holding company. So what that's going to do is that's going to knock down the percentage interest, obviously, and dilute the 60-40 shareholders, the existing ones. But not only that, the key employees, say he's just performing valuable services at operation company number 3, silo number 3, we have it as services 2, he's still going to be rewarded for all the success of asset services 1 and service 2. All the silos he'll get his percentage piece for. That's something where the word we really try to avoid, and that's oofta. And our shareholders are going to come back and say, oofta, I didn't mean to give this employee access to this much of the enterprise, because the true focus is only on one division. So an alternative structure would be to reward the employee at the silo directly for where the employee contributes most, and not with stock, but we could use phantom stock. We could give the employee a percentage of the net revenue or the profit over the division, over a set amount. We could get really creative to reward the employee on a basis attributable to the success of the division, but it just shouldn't be through stock unless that's the actual intention. A neat side benefit of this is we talked a lot about liability protection, but another reason to have all these silos is to create separate profit centers. And if you have employees whose compensation is going to be targeted to the separateness of one of the silos, well, now you have a watchdog that is going to help us explain to the jury that we're not doing this for any improper purpose, but we actually have a lot of legitimate business reasons for this structure. Now, Gary, it turns out if a claim is made, that's not a judgment, but there's a couple risky things that can happen if the structure is challenged, and there's a couple do's and don'ts of what we should do. The plaintiffs, are going to be coming in. They went to law school too, and they're firmly motivated to try as hard as we are to establish these structures. They're as motivated to try and bust these structures. Their two top techniques are to either try and pierce the corporate veil, or to proceed under what's called the single enterprise theory. Piercing the corporate veil, they would go after the shareholders themselves. If it's just cartoon characters, I guess we don't really care. But if it's you, you're going to not like that at all. And the single enterprise theory, they're going to go after the whole division. So they're going to try and put you in this box where all your eggs is back in one basket. But we said we want you to separate your silos and maintain the separateness of each, so we can contain the claim just to here silo number 3 or services 2. So a claim's been made. Everyone's worried. They're threatening piercing corporate veil or single enterprise theory. The corporation should not start flushing out cash and retained earnings. It should be mindful of extraordinary changes to its balance sheet unless it has a history of this kind of action. The company should avoid paying excess compensation to its owners, so don't start jacking up salaries right off the bat, because the creditors could recover excess distributions. And this is not the time to start buying back stock because those transactions would be likely scrutinized. Gary, what can you add to this?
Yeah, and I would tell you it's not prohibited for you to take the money out, but you're going to want to, again, follow proper corporate form. If you've been taking out distributions in the past, you have tax basis to do that. It's perfectly legitimate to take the money out. I think just all of a sudden jumping and doubling amounts or tripling amounts, know that it's going to be highly scrutinized. So we just got to make sure that, again, it's well documented. If you are taking money out, that it's put in the minutes as to reasons why you're doing it. And again, once we're going to continue to advocate corporate formalities, because everything will get looked at, and it's going to get looked at with a critical eye from a juror who may not understand some of the business complexities. Try to keep it simple.
Thank you. And that's the balance of our presentation. Have there been any questions?
There have, and let's advance to the Q&A slide, please. Several questions have come in. We're just over the 30-minute mark, but we do have time for a few. One is a simple clarification. The question came in, is a silo a services 1 example?
Yes, it is. So that would oftentimes be our operating company in trucking parlance. That would be the actual carrier.
Thank you, and let's go to the final slide so people have your contact information available, and maximize your slides, please. So here's another question that came in. Somebody said that they like the holding company structure that you talked about, but their businesses are all LLCs. Would this structure work for them?
From a legal perspective, the separateness of entities and the creation of a holding company for LLCs does work. And we would recommend, if you're under LLC solution now, to create this holding company structure and just instead of having QSSSs, they'd all be separate LLCs. That's from the legal side. Gary, can you reply from a tax perspective?
Yeah, from a tax perspective, again, no problems. We're going to have single member LLCs disregarded, so we can pretty much achieve the same tax structure as under the S corp scenario. Maybe some limitations in what we can do with compensation, but that's the only downside.
Great. Time for one more. Is there any advantage or disadvantage setting up a subsidiary company to house all of my employees and then lease them back to other companies?
I love that idea. I love it even more if you're leasing them to other companies that are not under the holding company and owned by affiliates of the holding company. It just gives greater integrity to the leasing company. Otherwise, under the solution that we're talking about, that's the preferred way to provide for multi-discipline employees working for all the subsidiaries, multi-divisional employees.
Well, we thank you very much. A number of people have asked about the PowerPoints. Please email Sean at truckwriters.com if you're interested in a copy of the PowerPoint presentation. Additionally, Nathan and Gary's emails are available to you on this last slide here. We encourage you to jot those down. We thank our excellent speakers today for this tremendous presentation, and TruckWriters for sponsoring another great webinar. With that, this web seminar is now ending. We hope you all have a great day.